Hey there, YouTube. So last week, I promised to show you my results of put sales that I entered. And these were on stocks that my software went out and scanned and found that there was high implied volatility over historical volatility and where they had earnings coming up the week after. I did have two go against me. One I made it out with barely a scratch, and then the other one got assigned to me. So this week I'll show you how to work out of it and probably still make a little bit of money working my way out. So with that, let's jump in. All right, so last week I showed you this is my list of stocks that we went through, and over here are my results on the right. So we looked at Palantir, I went into Arista Networks, AMD, Shopify, Eli Lilly, and Vistra. Those are the stocks I picked because when the market opened up Monday morning, like Uber, I was looking at getting into. I traded that the week before. Uber just didn't have enough volatility. I believe the price went up and it just didn't look like a good candidate after all. So the yellow highlights are the ones I entered. And then these were the spreads where I entered. So if you take a look at this side, I got a 148, 143. That's where I sold the 148 put. You remember last week it was suggesting a 147. Well, when the market opened up, I looked at it, and based on implied volatility and the expected move, it looked like a 143 would be the better choice. So I entered a 148 put, I sold that one, and I bought the 143 put on the downside so that I would limit my risk, right? We've went over that a couple of times in these videos. So here's 108, 165. I used $500 on these per contract. So this is my credit that I received, 31 on this one, $40 on this one, and 64 on this one. So this was my ROI. So $31 on a $500 risk is 6.2% return. So not bad for 1 week, 8% and then 12.8%. Now Shopify went against me, and actually it got assigned to me. So I'm going to show you how I'm going to work my way out of it over the coming week or maybe weeks. We'll walk through that here in a second. And then the one that really went against me was Eli Lilly. It's because one of their competitors reported earnings this week, and because they had a huge earnings miss than the expectation, because Eli Lilly and this other competitor are kind of side by side, offer the same type of product, they both tanked. And Eli Lilly tanked quite a bit. It went from like 812 during the week down to $750, $60, something like that. So well below the expected move. So let's jump in, and I'm going to show you how I'm going to get out of Shopify. But before I do, let's take a look at the first three, and then we'll go from there. Okay, so here's Palantir. This was the first one I entered. I entered at 148, and I got $31. So I sold this one, and then I ended up buying this one, and my credit was $31. You can see that the stock stayed above that all week long. It was profitable right away, stayed profitable, and I collected my $31 on a $500 investment, $500 per contract. I'm going to use words like 31 cents or $31. It's the same thing. It's just what multiplier I'm using, because options trade in hundreds. If I say 31 cents, that means 31 cents per share. Or if I just use 31, then that means it's all automatically multiplied by the 100. So they're used interchangeably. So if you hear me say cents, it's really dollars. It's just whether it's per share or per 100. All right, so just kind of get that out of the way, because I do that from time to time, and I go back and I watch my videos. I'm like, oh, that was confused. I get more than 40 cents. I get, $40 per contract. All right, so here's Arista Networks. I entered a trade at 108. That was the expected move, and you can see it just stayed up all week. AMD, the same thing here. Market opened up Monday morning and entered 165 with a $160 put. So my risk here was only $500, but I made $64 as long as it went up. But if it went down, my maximum risk was $500. This is why I buy this bottom one. It's a little bit more capital efficient to do it this way. All right, so let's jump into Eli Lilly first, and then we'll go into Shopify, because Shopify is the one I got assigned. Eli Lilly, I took the loss. So when Eli Lilly opened up Monday morning, we were sitting here roughly around $812. It tanked on Tuesday because a competitor had a huge earnings miss. That caused Eli Lilly to go well past the expected move of was down to 780. Is where I'd selected. I think the expected move was like $20, $30 that morning, and so I went down a little ways because it was 812, and so I thought, well, I think 790 was where it was at for the week, so I went ahead and selected the 780. So sometimes you don't have winners. That's just how you play this. So it went down right away. It went down to like 755 that morning, kind of worked its way back up. I did not close it out right away. I think if I would have closed it out here, I would have been around $500-$600 loss. Remember, my maximum loss on this is $1,000 because I've got a $10 spread. So per contract, my maximum risk was $1,000. But because I had some time left in this bottom spread, in this bottom part of the spread, this was making money while this one was losing money. And I had some time. And I had volatility, so this one became even more expensive. So that's why when it came down here on Tuesday morning, I didn't realize the full $1,000 loss yet. Now, if it would have stayed here at the end of the week, then I would have had my $1,000 loss. And I decided not to. So I waited for the day to see if it was going to pop. And maybe bad news, and it's like, never mind, it's fine, it'll go back up. And if it would have went back up to that 780 mark, I would have probably, and it did for an hour, I would have probably waited and seen if the next day it went up. So it kind of went back down. Well, Tuesday, it never popped. It did not pop back up, knowing that this bottom put was going to decay. Remember, it's making money at this point. But if I would have waited to the end of the week, it actually, time decay would have killed this one, and I would have no profit in it. And then this one would have been its maximum loss as well. So on Tuesday, I went ahead and closed the position for a $366 loss. I received a $104 credit. I sold it for $471. And so that means I took a $366 loss. That was the spread. That was just like, forget it. It's so far down below my break-even point, way below it. I needed to be like at 779. And it was trading in that 760 range. So I'm too far down. The probability of it hitting there was like 20 or 30%. I'm like, nah, I'm not going to wait. I'll just take my hickey and I'll move on. The other thing I did do is on Tuesday when it tanked like this, I took the risk and I said, well, I'm willing to, and this is a matter of preference. If you want to do this, great. If not, it's not a big deal. But I thought, well, now let me go find the expected move from where it is now, because volatility went up even more because of this somewhat crash on this stock. Volatility then had like a $30 or $40 move, expected move. So I went down and I put another spread on at 725 to 712. So I took a $1,200 spread, $1,200 risk, but I got $88. So I went way out of the money, thinking that, what are the odds that it'll go down there? Now I know that I'm taking this risk, and I know that I'm taking this risk, but I was okay with that. Well, this made $88 because it never fully got down there and stayed above that the whole time. So this made 88. This lost 366. Together, it was a $278 loss for the week on this one position. So because I took that initial $1,000, I'm just going to use this. That was a 27% loss on these positions. Technically, I had held up another one for $1,250, but just for simple math, roughly a 27% loss on my original $1,000 investment. Not bad considering I had profitability on the other ones. So look at all of the other ones, and then we'll jump into Eli Lilly. So we talked about all of these profits here. So all in, I was up $207 on all the positions except for Eli Lilly, where I took a $366 loss on the initial one, made 88, so it was $278. So $278 loss, 207 on everything else. I actually lost $71 for the week if you're doing one contract. Now I entered more than that, but just for simple math. So $2,500 investment on each, just one spread, losing $71. Remember the weeks before, we've had a 100% success rate all the way up until this point. So now I have two that I'm down. I have one that I'm down, and I have this other one that I'm going to get assigned, or I have been assigned, and I'll show you how to work out of that. So let's jump into Shopify. I hope all that makes sense. If you have any questions, please drop something in the comments and I'll do my best to respond. All right, so let's take a look at Shopify. So on Monday, given the expected move, I've showed you how to do that before on previous videos, find the expected move and then add a little bit. I had entered it at 120 with a 115 put on the downside so that my risk is capped to $500. Well, during the week, it was profitable. And then on Friday, because of the whole market falling, it also fell in sympathy. So it fell down to about the $118, $119 range. And I got $28. So my break even is really $119.72. But because it didn't go below this, if it would have went below the 115 mark, I would have lost 500 minus the 28. But instead, it stayed right in between. And I'm glad it did because I wanted to show you how to work your way out of this. So I've gotten assigned. I was selling a put at 120. So it means I'm going to get assigned at 120. Now I made 28. So my cost basis is $119.72, right? Because I got to subtract the 28 that I've already gotten paid. But for simple math, the broker assigned me 100 shares per contract at 120. So that's $12,000 per contract that I'm going to have to pony up. Now, this one just expired worthless. This one got put to me. So it's $118.60. Now, here's what I'm going to do is I'm going to buy, because I've got earnings coming up this week on Shopify. I don't want to take a big risk through Shopify, through earnings. So therefore, I'm going to buy a put on the downside and sell a put even further down. And then I'm going to sell a call. Let's walk through that. So if I go out to the platform and I look at my expected move is $14.18. That is what the market, as of Friday, was putting in for an expected move. Volatility is high, and therefore premiums are very expensive. So at $14.18 at $118.60, that puts us down to about $104 is the expected move if it were to go down to the downside. So $14 to the downside and then $14 to the upside. By the end of the week, they're expecting the price to be somewhere between 104 and 132-ish. That's just what's priced in. So I went back and I looked at Shopify's earnings over the last 2.5, 3 years, and going back to the first part of Feb 2022. So every earnings, it came out whether it was a hit or a miss, didn't matter. I just wanted to look at the next day's performance was. So you can see we're down 11% on this one. We're up 8. Our worst case scenario is 15.88 on the downside, 8% on the upside, and you go all the way through. So the average of all of the last several years worth of earnings is 0.09, with the minimum at a negative 15.88 on the downside, and then the maximum upside was 8.62. So that kind of falls in line with, because if I were 15% of 118, that puts us down to around $99. You're looking at about a $19 move if it follows this one here, a worst case scenario over the last 2.5 years. That puts us pretty much in line with this. If this is a $14 move here, that puts us down to 104, and our maximum loss in this period would have put us down to 99. So you kind of see where I'm going, where I'm going to sell my put. I'm going to buy one at the money, and I'm going to sell one way out of the money because I'm going to protect myself all the way down to my maximum here. My maximum upside, I'm not worried about. Now, if you're an investor and you think, hey, I want this thing to shoot through the moon, maybe you just buy insurance and you don't sell the call. I don't care because I'm just looking at this as an income play. I don't care that it goes to the moon. I just want my money back. I made $28 here, but I'm at a little bit of a loss, about $100 or so. And if it goes all the way down, I don't want to take on any risk. So let's walk through that. So I'm going to buy a put right here at 118. So next week, this is where my put's going to be. This is going to cost me $6.65. If you were to go open up this and you go look at what a $118 call is, as of Friday, that's what it was costing me, is $6.65. So I'm going to spend $665 to buy downside protection. But I don't think this thing's going to go all the way to zero, right? It's $150 billion, as of $150 billion market cap. So let's go all the way down to our expected move. And we think that the expected move based on options pricing and based on what we've seen before, I'm going to sell a put here. So I'm going to protect myself to this down here. I'm protecting myself in this range. Now, if it goes below that and I'm wrong, it might go down to, say, my worst case in the last 3 years was this. If it goes down there, that's $99. And if that's the case, I'll show you next week how to get out of that. So this one, I'm going to sell for $1.80. Okay? So that means I'm going to buy it here. I'm going to sell this one here. My credit, my cost of insurance to protect me all the way down to 104 is $485. It's basically what I'm paying for here, selling this one to help finance the cost of this guy, knowing that I don't think it's going to go that far south because just looking at my averages, right? I hope that makes sense. What I'm going to do next, though, is I'm going to sell a position at 120. So this is going to be my call. All right, I own these shares at 120. So now I'm going to sell a covered call. I'm going to buy this insurance and I'm going to sell a covered call with it. That way, if the stock goes up, that'll just get called away. This guy's selling for $620. Again, I'm an investor, not a speculator. I am willing to hold Shopify if it goes below 104, and I'll work my way out of it even at that price. But as an investor, I'm not looking for this thing to shoot to the moon. I'm looking at how do I get income off this. So now, check this out. I'm getting paid $620. I'm telling the other guy who's buying this from me, I'm selling a call. I'm saying, hey, I will sell my stock to you at 120, but you're going to pay me $620 to sell it back to you. So he's buying insurance for some other reason. Or maybe he's thinking that it's going to go to the moon. I don't care. I just care that I get... Basically what I care about is I don't want to pay for this insurance. I want to finance it with this. So here's the cool part about this. So I'm getting paid $620. I got to pay $485. Now I've got $135 credit. This is what I'm going to get paid to do this. So I'm down $100 right now on my stock, but I'm going to get paid $135 to enter to buy insurance. But I don't get any upside. If the stock on after earnings, goes through the roof, I'm not going to get to participate in any of that. I don't care though, because what I care about is risk. I'm risk managing my position here. I'll get paid $135 if it goes all the way up there, plus the 28 cents that I made or $28 that I made the week before. So that's not a bad play, right? All right. So if it goes down to $100, I'm going to get paid $135 because I'm going to enter this whole entire spread as a covered call, buy my insurance. And if I go down to 100, let's say it tanks 20%, then I'll be at a loss from 104 below. Okay? If that happens, I'll show you how to get out of that next week, because we'll end up probably doing the same kind of position. Implied volatility will still be high because it's tanking, and I may sell a $104 call because that's where I'm at. That's my break even is 104. All I've done is just reduce my cost basis down to $104. And if it goes up, great. I'll get paid $135 plus whatever I got paid the week before. So I'm going to do a video on this again next week, and we will show how we're going to work out. So I hope that makes sense. If you have any questions, please drop some notes in the comments. Now let's go up to next week. So next week, I went out and scanned the universe again. Software Scan the Universe. By the way, if you're interested in this list on a weekly basis, I do sell it. It's $75 a month. and you can subscribe and get this list. And again, you do your research, but this software does a lot of the work for you and tells you what the strike price should be, what the expected ROI is, and all of that goodness. And it goes out and scans all, 3,000-4,000 stocks. All right, so here's what we've got. Earnings are starting to wind down, and so we've only got a handful of candidates to choose from. I will look on Monday morning and decide where I enter. CRM at this point looks to be the best. I may play NVIDIA, and I may even go up a little bit higher. NVIDIA is just on fire. And I may go up a little bit higher on this strike and see if I can collect some premium there. I've played this one before, Palo Alto. Doesn't look like there's much juice. Now, again, this is using our minimum bid, what the bid price is right now. So this could actually be a little bit higher on Monday morning. So I'll take a look at these and we'll decide then. And I will report on that next week. Last thing is, this is what's coming up this following week. Here are the stocks that we had played last week, or we had scanned last week. We're not trading any of these except for Shopify. All right, these are what's reporting this coming week. And then here's a handful from the week after. This is why we don't have a big list, is earnings is coming to a close. So we didn't have a big list to choose from. And then here's a couple for the week after, but we'll play those in next week. So we'll probably do one more video, one to show how to get out of Shopify, and we'll go into that in the same video, and then we'll probably have just one more week worth of earnings that will be worth it, and then we'll see where we go from there. So with that, do your own research. Happy trading. If you like this, please let me know in the comments, subscribe, whatever, and let me know. Show me some love, and happy trading. Oh, one more thing. This is not financial advice. Please do your own research. Thanks, and have a good one.